Hey everyone, welcome back to Corporate Decoder, the place where we break down all the financial jargon so you do not have to. Guess what? We've got another exciting filing from TFS Financial Corporation. Now, usually these 10K reports can be a bit dry, but this one has some juicy details about their operations, their risks, and most importantly, their financial health. Stick around because we are going to decode it all for you. Alright, let's dive into TFS Financial Corporation. This is essentially the parent company overseeing the association, which is the main bank. They had their big public stock offering back in 2007, and since then they've been growing. Their primary business is still really focused on what the association does, which is retail consumer banking, like giving out mortgages and taking deposits. Now, before we get into the nitty-gritty numbers, they toss in a lot of forward-looking statements. These are basically their best guesses about the future, and they are always going to warn you that things could turn out differently. They mention competition, inflation, economic conditions, and even global events like war or terrorism as potential risks. They also highlight cybersecurity as a big concern, which frankly is no surprise these days. What is interesting is how they explicitly mention that their business could be impacted by changes in government policy, tariffs, and even the US government's ability to manage its debt, which shows they are thinking broadly about the economic landscape. Let's talk about money, how they make it. A huge chunk of their business is lending out money mainly through residential mortgage loans. They also offer home equity loans and lines of credit. At the end of September 2025, their total loan portfolio was over $15 billion. That is a lot of homes being bought and financed. The biggest part of that is residential core loans, which made up almost 69% of their portfolio. Home equity lines of credit are also a big deal, representing almost 26% of their loans. Looking at their loan portfolio composition from September 2025, we see that residential core loans were about $10.8 billion. Florida and other states made up a good chunk of that, with Florida at $1.8 billion. Home equity lines of credit were also substantial at over $4 billion, with California being a notable market there at over $681 million. When we look at loan portfolio maturities, we see a clear strategy. The vast majority of their residential core loans, almost $9.2 billion, are due after 2041. This means they are locked into those interest rates for a very long time. This can be good if rates fall, but risky if rates keep going up. They offer a product called Smart Rate Adjustable Rate Mortgages. These are fixed for 3 to 5 years and then adjust annually. Why do they do this? Well, it helps them manage risk. When interest rates are going up, their fixed rate loans could become less profitable. These adjustable rate loans help to balance that out. They also emphasize affordable housing programs, trying to help people achieve home ownership, which is a nice touch. Their home equity products are a hot ticket item, totaling over $4 billion in lines of credit at September 2025. They have a good chunk of these in Ohio, Florida, and California. Interestingly, a significant portion of these lines of credit are in their draw period, meaning borrowers can still take money out. This adds a layer of uncertainty to their future funding needs. Now let's look at how well people are paying back. At September 2025, loans delinquent for 90 days or more were really just over $17 million. That sounds like a lot, but when you compare it to their total loans of over $15 billion, it is actually a tiny fraction, less than 0.1%. This suggests they are managing their credit risk pretty well. When loans become really problematic, they're called non-performing assets. At September 2025, these were only about $40 million, which is about 0.23% of their total assets. That is quite low. They are actively modifying loans to help borrowers stay in their homes, which is a responsible approach and shows they are trying to avoid foreclosures where possible. This is a really important number, the allowance for credit losses. It is basically their rainy day fund for when loans go bad. At September 2025, this allowance was over $104 million, that is about 0.67% of their total loans. It is good to see this number is stable and even grew slightly, indicating they are being cautious about potential future losses. Let's look at the big picture numbers. Total assets are around $17.4 billion. Loans held for investment net are $15.6 billion and deposits are over $10.4 billion. This shows a healthy operation where deposits are funding a good portion of their lending. When we look at their income statement for the year ending September 2025, net income was just over $90 million. That is a nice increase from the previous year. Total interest income was $763 million, while interest expense was $470 million, giving them a net interest income of over $292 million. That is the core of their banking business. Their return on average total assets was 0.53%. While not spectacularly high, it is pretty standard for a bank of this size and indicates they are managing their assets effectively. Their efficiency ratio was 63.54%, which means for every dollar they earned, they spent about 63 cents on operations. That is an improvement from the previous year, indicating they are becoming more efficient. One of their biggest concerns is interest rate risk. Since most of their loans are long-term fixed rate and their deposits can reprice faster, they are vulnerable to rising interest rates. They are trying to manage this by offering adjustable rate loans and shortening the duration of some of their funding sources, which is a smart strategy. Liquidity is king in banking, and TFS Financial Corporation seems to have plenty. They have strong deposit inflows, FHLB advances, and other borrowing capacities. Their liquidity ratio averaged 5.47%, which is well within their target range. They also maintain high capital ratios, well above the requirements to be considered well capitalized. This is a sign of financial strength and stability. Deposits are their lifeblood, and they are doing well here. Total deposits are over $10.4 billion. Certificates of deposit make up the largest chunk at over $8.4 billion. While they have a good amount of uninsured deposits, around 387 million, it's important to note that the majority of their accounts are still well within FDIC limits. When they need more funds, they can borrow. At September 2025, they had almost $4.9 billion in borrowings, mostly from the Federal Home Loan Bank. This isn't unusual for a bank, and they have plenty of room to borrow more if needed. Their investment portfolio is primarily in low-risk government-backed securities, totaling over $520 million. This provides them with safety and liquidity. They are not taking on risky investments, which aligns with their conservative strategy. Regarding fair value, most of their assets and liabilities are measured using observable inputs, meaning their fair value is readily known. Things like government bonds and mortgage loans held for sale are valued this way, some items especially collateral. Dependent loans and interest rate lock commitments are in level 3, meaning they rely on unobservable inputs. This is where the most estimation is involved, but it is a small part of their overall fair value measurements. Going back to loans, the allowance for credit losses is key. At September 2025, it was $74 million for loans and another $30 million for unfunded commitments. This shows they are prudently setting aside funds for potential losses. The fact that their residential home today loan portfolio has a negative allowance is interesting and likely due to expected recoveries on older loans as they are no longer originating them. And finally, the auditors Deloitte and Touch LLP gave them a clean bill of health for both the financial statements and their internal controls. They did highlight the allowance for credit losses as a critical audit matter, meaning it involved especially challenging subjective or complex judgments from management and required significant auditor judgment. This is common in banking, as estimating future losses is always a bit of an art. So what is my take on TFS Financial Corporation? They seem like a very stable conservative bank focusing on their core business of residential lending and deposit taking. Their strengths are their strong capital position, robust liquidity, and a conservative approach to risk. Their main challenge remains interest rate risk given their balance sheet structure. They are working to mitigate this through loan product mix and hedging strategies. The fact that they are actively managing their loan portfolio and have a healthy allowance for credit losses suggests they are well prepared for potential economic downturns. The upcoming core banking system upgrade is a significant undertaking, but if successful should lead to greater efficiency. Overall, they appear to be a solid player in the financial sector. What do you think about TFS Financial Corporation's latest filing? Are their risk management strategies enough to navigate the current economic climate? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more insights into the world of finance. And hey, if you want to talk more about these filings, join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.